Hello everyone, welcome to Analog IAS Prelims 2020 special series of economy, and today's topic will be Basel Norms. With respect to Basel Norms, recently there was a report that commended RBI's role in ensuring that large exposure rules are stricter than required. Now let us understand the significance of this news. Basically, Basel Norms are about how to run a financial system properly. So there is a Basel Committee on Banking Supervision which focuses on risks to banks and financial system. So what is this Basel? Basel is basically a city in Switzerland and it is the head of Bureau of International Settlement. So this is the body which regulates amongst central banks and ensure that financial stability and macroprudential issues are handled on a global scale. So the common goal of Bureau of International Settlement is financial stability and common standards of banking regulation. So if you take a look at the purpose of Basel norms, it is basically to ensure capital is enough to meet the unexpected losses that banks might face when they are doing business. So India is already a member of Basel Accords for the banking system. Now what is the significance of this capital? Before proceeding further, let us have a look at this. What is the most basic framework of how a bank functions? Say a depositor has 100 rupees, he deposits this money in the bank. Now the bank uses this money to give a loan, and upon using that loan in a business, the businessman who took this loan would pay back an interest, say 10%, and bank would keep around 5%, say for example, and give the rest 5% to this customer. This is the most simplistic explanation of a bank. Now imagine a case where this businessman is not in a position to pay back the loan, either willfully or because of the failure of his business. What is the position of this depositor? Now in this case, if there are various such depositors, all of them would attack the bank at once. Bank would never be in a position to give that money back. The sole reason is because this particular bank has given their entire amount to a particular person whose business failed. For example, let us take the case of Vijay Mallya. If a bank has taken deposits from various customers and gave that money to Vijay Mallya alone, we'll say that the exposure, the loan exposure of that bank to a failed entity is very high. So in order to ensure that these kind of bad business decisions are not taken, and there is also a possibility that people involved in this banking are gambling with people's money, there are certain norms which are called Basel norms. Now what is the role of capital in this whole picture? So before you start the bank, in a situation where a person like Vijay Mallya is not able to pay back his money, in order to ensure that the bank pays back certain amount of money to its depositors and also ensure that it pays its employees their salaries. Also, there are various operational costs involved in banking. Now, you cannot always expect a depositor's money to be the basis for carrying out banking operations in our country, because there is a large scope that a particular asset, that is a loan, might turn into a non-performing asset. So instead of speculating that whether this person is a risky proposition to lend to or whether a corporation is a risky business to lend to, the bank should have a minimum capital requirement. This capital requirement is based on the RBI Act 1934. So scheduled commercial banks have a minimum capital requirement. However, the capital adequacy, that is, if you want to lend more, whether that capital is enough or not is decided by Basel norms internationally. Now let us have a look into what this capital adequacy is all about. So to put it in simple words, capital is nothing but the minimum amount required for carrying out a banking business without depending upon depositors' money. So the Basel Committee in 1988 came out with this Basel I norms. So this is called the Capital Measurement System, or simply Basel Capital Accord, or Basel I. In this, they said that 8% of the risk weighted assets should be the minimum capital requirement for a bank. Now, what is this concept of risk-weighted assets? For example, you have 100 rupees worth loan given to different set of customers. Say you gave 50 rupees loan to one customer, 30 rupees loan to one customer, and 20 rupees loan to another customer. The probability of failure of first loan is valuated at 10%. So you have to keep aside 10% of 50 rupees, that is 5 rupees aside without lending. And if it is 30 rupees and if the probability of failure is 20%, so in this case you have to put aside 6 rupees. And in this case, if it is 50%, you have to put aside 10 rupees. So the total amount is 21 rupees. So based on this risk evaluation profile, for every 100 rupees that you are lending, you should ensure that there is 21 rupees of capital in your account. So unless and until you have 21 rupees to ensure that these failures can be cushioned, you cannot lend this 100 rupees. That is the concept of risk weighted assets. This is the minimum capital requirement. In the Indian context, it is called capital adequacy ratio. It is the same as minimum capital requirement. So whenever you come across the news regarding capital adequacy ratio, it is nothing but minimum capital requirement. So India adopted this Basel Norms guidelines in 1999, not 1988. Okay, please note this point. Now, after Raghuram Rajan has taken the role of RBI's governor, there was a lot of emphasis on digging out the amount of non-performing assets in various banks. The reason is because RBI slowly has moved towards Basel II norms. The minimum capital adequacy requirements of 8% was already laid down in the Basel I norms. So, extension of that is the Basel II norms, where two other pillars, namely supervisory review process and disclosure and market discipline, were added as different components for banking regulation. Now, what does supervisory review means? It basically means if a particular bank is exposed to one single lender, which is a risky proposition. Say in the previous case, say for example, if SBI has lent to Vijay Mallya, if the investors of the bank are not aware that they lent nearly 70%, I'm just quoting this as an example, they lent 70% of their money to Vijay Mallya, and if Vijay Mallya business fails, 70% of the loans are going to fail. That is a very risky proposition. Like they say, you should never put all your eggs in a single basket. So in order to ensure that investors have better information to take their decisions whether to invest in SBI or not, you should show what are the operational risk, market risk and credit risk involved in the process. That is the supervisory role ensured in Basel II norms. The third thing is market discipline. So you have to ensure that the disclosure requirements are adhered to. Banks need to show from time to time to auditors and investors the board of members, minutes of the meeting and different aspects discussed in banking. So unless and until we have a discipline which is transparent enough, the banks will not be able to function efficiently. That is the basis of Basel II norms. Now let us look at Basel III norms. Basel III norms added one more aspect, that is the important aspect as far as India is concerned, is the capital cyclical buffer concept. So whenever there is an economic boom, we generally tend to borrow more. So there is this concept saying that counter-cyclical, it is called counter-cyclical capital buffer because we want to put aside a certain amount of capital. According to Basel norms, it is 2.5% of the risk-weighted assets. So you want to keep aside 2.5% of that capital to ensure that just because in the booming phase you are lending a lot, it doesn't mean that all the businesses would be seeing a success. Now, for example, in 2007-2008, Indian economy before this phase was having a brilliant phase because we were witnessing economic boom and banks were more than eager to lend because of expectation of better return. credit growth was fantastic. But what happened after the global financial crisis? We have seen that after many years, when the boom period ended in 2012 2013, our NPAs have risen significantly. Now, after RBI started digging all these, we have seen that the NPA as a percentage of the total loans almost reached 12% of the assets. So, this is what happens. In order to ensure that this scenario does not repeat, Basel III, especially after the global financial crisis, ensured that we have this counter-cyclical capital buffer. Now, whether RBI adopted these norms, we already adopted these norms in 2015, but we have to note that its implementation was postponed till 2020 March. Because of COVID-19 crisis, RBI decided to extend this indefinitely. RBI did not notify from when we will be implementing these measures. However, out of this 2.5%, a certain amount of counter-cyclical capital buffer is being maintained by certain banks already. So, in that context, Basel Committee has commented that RBI's norms regarding exposure to a particular firm are more stringent than expected. That is the news that we were talking about. This is all about Basel norms. So, stay tuned for other news regarding economy. We'll be coming up with more videos. Thank you.